Welcome to Investment 101, where we break down the basics to help you make a smart decision on your property investments. I'm Laura, and today we're talking about a hot topic, interest rates. Interest rates are either the fee that you pay the bank for borrowing the money, or the savings that you make from using the bank to save your money. It's typically expressed as a percentage. So in terms of property, if you're taking out a mortgage, it will be the fee that the bank charges you on top of your original repayment of the total price. And then if you're using a bank to save the money, it's the reward that they give you for using their bank to save it. So what's important to know is that interest rates will directly affect your mortgage. The first thing to consider is your monthly repayment. So typically, if the interest rate is higher, that means your mortgage rate will be higher. If it's lower, your mortgage rate will be lower. Second thing to consider is that the total repayment will also increase or decrease. So equally as with the last point, if your interest rate is higher, then the total repayment value will be higher, and equally lower means lower. Final thing to consider is the type of rate that you have. So you'll typically be offered one of two. It'll either be fixed or variable. With your fixed rate, it will be really nice and reliable. You'll know what's coming no matter the trends. If it's variable, it's a little bit more risky. If it goes up, then you'll be paying more. If it goes down, then you will be paying less. There's a few key factors that will influence your interest rates. I'll go over a few of them. First is inflation. So typically when inflation rises, the banks will also raise interest rates. And this is just to cool off the inflation, because essentially when borrowing is more expensive, people will borrow less. So another factor is the economy's overall performance. So if borrowing is really high, the banks will try and increase those rates just so that the economy doesn't overheat. Equally, if it's relatively low performing, then they'll try and decrease the rates to encourage a little bit more spending. The other thing to consider is central banks' policies. So banks like the Bank of England will generally control the rate. Slightly smaller banks are likely to essentially listen to them. When they lower their rates, they will try and follow the same trends, and when they increase them, they will do the same. Finally, global events can also play a role. For example, political instability, economic crisis, or as we've just seen, pandemics can have an effect on the interest rates. So there's a few things that we would recommend for investors to plan for fluctuating rates. First and most important is to monitor the trends. Secondly, consider a fixed rate mortgage. If you opt for a fixed rate mortgage, then your outgoings are a little bit more reliable. If you really need flexibility, then you can get a variable mortgage, but just make sure you build a buffer into your budget. So there you have it, a clear breakdown on interest rates and how they affect property investment. If you like this video, don't forget to like and follow us across our channels. And if you have any other questions, please don't hesitate to drop them in the comments below. Thank you for watching, and we'll see you in the next episode of Investment 101.